Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to be looking at a bunch of different information pertaining to the TYX TNX ratio and the 2-year yield. And what we're looking for is market conditions and certain assets performing a certain way under certain market conditions. The value of an investor, what you need to know as an investor is what assets work in what market conditions and what market conditions we are in. And in order to find that out, you have to look at things and overlay data to see what correlates with what. So it's important to understand how things are moving against each other. If you look at enough data across the board at enough ratios, it should paint that picture for you, at least to some extent. And what I'm going to do is I'm going to try to paint that picture for you during this this video right here. These are things that I look at. These are things that I take into consideration when making investments, especially new investments. And some things correlate and some things don't correlate. So you can't use one indicator or one metric for everything. You have to use a combination of a bunch of different metrics, a bunch of different inputs. You've got your process, and then you got to look at what your outputs are. What are the ramifications? What does well under certain market conditions? What doesn't perform well under certain market conditions? Where are the risks associated with certain market conditions? Market conditions, so let's just kind of go into that real quick. Market conditions are the conditions, the financial conditions that people are subject to that trade and buy and sell things in an economy or market. So in an inflation, increasing interest rate environment, humans behave differently than what they would in a low inflation, low interest rate environment. Money flows change under different market conditions. What we need to do as investors is identify those market conditions and front run the money flows. So basically, we're going to buy before people realize that inflation's a problem. We're going to buy before a big market takeoff, or we're buying right before it into that strength where humans are starting to figure out or starting to feel that difference in the market conditions. And that's how you make the big money. Now, I don't play every single market condition with all of my money in one sector or one asset. I have a gigantic position, we'll call it core position, whatever. I kind of let that ride in the big secular bull market theme, because some of these sectors may or may not respond to some of the inputs. So you don't know exactly, you're not going to have a clear signal that it's going to work 100% of the time or not. So we're playing with statistics, we're playing with probabilities. I know people will say, well, what's the exact probability? Does it really matter if it's over 50%? Maybe it's 60, 70, 80, 90% for some of these technical chart patterns. Some of them are greater if you can stack and get an alignment of conditions. So what is an alignment? Let's just go over real quick. Let's say the TYX TNX ratio is low and it's starting to come up and we've broken a downtrend. So that's one piece of information. A second piece of information is gold is putting in a bottom and starting to head on higher and has broken a downtrend as well. Gold in relationship to other assets is cheap. That's more information. So we've got TYX TNX ratio signaling a market condition change favorable for gold. Gold's breaking out of its downtrend line. Gold is priced cheaply against all the other assets. The money is not there, but it could be flowing back into it given the new market conditions. And then you can maybe even look at leveraged ways to play it with gold and silver mining companies or royalty companies. And let's say they are breaking out of their patterns. So you've got this big alignment. And we do have the alignment today. So the alignment goes and stretches from market conditions changing from the bond market and yields, which rotates money differently in the markets. And we're seeing positive signals across the entire we'll call it chain of events or different asset classes that are moving and positively inflecting for a change in valuations. So the money flow is starting to flow in there based off of the conditions, based off of potentially, we'll call it fear in the markets or whatever market conditions and the emotions that are associated with those market conditions and the people in it, the herd and their mentality and the way that they are trading in those markets. So let's take a quick look and I'll show you some of the things that I look for in the markets. And again, I didn't read a book on this. This is just me developing it myself. I mean, it's pretty obvious if you can see correlations and stuff like that. But let's dive in here real quick. So we've got the TYX TNX ratio. That's this guy down here. And then the orange line is gold. Gold, it's the price of gold in the United States dollars. And this is TYX TNX is the 30-year yield divided by the 10-year yield. I have it inverted with the 30-year before the 10-year because it mimics the same direction as the gold price. So you guys can see the correlations a little bit better. So as we look at this, what you can see is, generally speaking, when we get an increase in the TYX TNX ratio, you get an increase in the gold price. When that ratio comes back down, you can see the ratio comes back down. And you can see this go back and forth with the price and the ratio. So you can say that these are pretty tightly correlated. Obviously, I could throw other assets up here, and they're not as correlated to this move here. So what we're seeing, if we look here recently, we saw this is the yield curve inverting. That means that the 10-year yield is going up at a faster pace than the 30-year yield. So this yield is going up, it's going up, and the curve is inverting. Gold does not like that inversion. Does not like it. But we went to a very low level. I've talked about this before. I said, hey, when we get to a low level, this might be a good spot to be looking at gold prices or gold investments. Well, we bottomed in gold. Gold's starting to head higher, and we've broken the downtrend line in this TYX TNX ratio. Is this signaling a new market condition change? No one's going to know with 100% certainty. But what we can say is gold is going higher. We have broken some pretty good downtrend lines. So if we have a trend line here, we've broken through that trend line to the upside for gold price, that orange line there. And we've broken the downtrend line for the TYX TNX ratio. So let me get the gold out of there. You can see this ratio we've broken out. And yes, it could fall and come back down here before heading higher. Not saying I know the exact path. No one does. But it looks positive for this ratio to continue higher in the short term, medium term, and long term. So we have all those time frames that are linking up. Gold is also moving higher, which is more information to solidify our thoughts around TYX TNX ratio. So the next thing that we can look at is we can look at some of the ETFs. We can go through that. And we can also look at the 2-year yield, which is even shorter in duration here. So here's the 2-year yield. We got a long-term big picture view here. We've got a downtrend line. We've broken that downtrend line, signaling a new paradigm. It's signaling that we are most likely entering a period of time where we're going to have an inflationary environment. But in these environments, you can see that this is a disinflationary environment that occurred over 40 years. But we had these cyclical movements within a large decline. So, yeah, this is declining, and you would have had one heck of a time investing in stocks and bonds because they've been going up during that entire period with lower highs and lower lows for yields. But what I am suggesting here is that that paradigm has shifted. It's changed into an increasing interest rate environment, perhaps, because of the downtrend breaking. Now, that doesn't mean that we go straight higher. Everyone, I don't know what it is with Twitter, YouTube, and everyone else, but everybody thinks if I say that something's going to go much higher, that they think it's just going to go there in a straight line. That is not how markets work. We cycle back and forth. Obviously, we've had a large move in interest rates up, and we're probably going to cycle back down to some extent. That cycling down could be fear in the markets or a recession. And just because you have a recession does not mean that the housing market's going to completely go down. The housing market is generally a driver of the deleveraging event. I'm not saying that we're going to have this gigantic deleveraging event. What I am saying is when interest rates go up, there could be a bunch of garbage in the system that needs to get cleansed out of the system. Much like the 2000 to 2002 type era. So if I were to go back to the TYX TNX ratio, look at it from a longer term perspective here, and zoom in on some of these spots here. So this is the last bull market from 2000 all the way up to 2012. That's the bull market, and this is what it looked like for this ratio. Gold did incredibly well all the way up to about the top here and kind of peaked out, and that's before rates peaked out. We can also look at it from other, technical analysis standpoint, where we basically squeezed up to the top here, broke out, did a retest move, and then just beelined lower. So that's a squeeze up of a rising wedge pattern. So what I want to focus on is the beginning of the bull market happened in 98, 99. That's our buy signal was back here. It came one last hurrah lower for this ratio, and then it was basically higher from there. We went in 2000, the ratio was increasing, and we got an inflationary impulse move. So this is the recession that came. That started in 2000 all the way to about 2002. 2003, we started to turn back over, and this was the inflationary move in a lot of the commodities. Oil and all this stuff. We came all the way down and we compressed to a very low level. You can see that we had a trend line break here. That was a trend line break. And then we went sideways. We went sideways for February of 06 all the way to about July of 07. It went sideways for a little over a year. So we started that move kind of in 02, 03 up here, came all the way back down, and it ended in 2007. When this goes back up, gold generally outperforms or does very well when this ratio goes up. And during this time that it goes up, we generally have a problem in the market. We have a deleveraging event, we have a recession, some type of event occurs. This one happened in 2008. It was in this general area as we were going up that we had a deleveraging event in real estate where real estate sold off. So this was front running that move before the move was done. So it's basically saying, okay, the yield curve's inverted, we're going to stop inverting, and then we're going to uninvert. And when it uninverts, that's when the problems generally surface. When we look at where we are today and compare that to last bull market, we've got a bottoming where they did a reflation trade up at July, August of 2020. And remember, gold did not like August 2020 onward with all that money printing. It accounted for it in March. March 2020 is when they had the money printing, and that's when gold took off, and then we finally came back and had an inversion of the curve. We've broken the downtrend line much like last time, but that doesn't mean that we just go straight on up. What it could mean is that we go sideways for a little while before heading higher. So a lot of the people say, well, oil can't go up. Oil can go up, especially if this just goes sideways for a little while. But it's prudent, or it might be a good idea to look for investments that work well in a uninversion of the curve. That is gold, silver, and potentially platinum for that type of investment. And keep in mind, we can go sideways down here for a good long period. We can bounce back and forth, going sideways for maybe even over a year, just like we had last bull market. But there is one thing that is very much different from the middle to late 2000s and today, the housing market hasn't weakened that much. I know a lot of people, a bunch of, I'll say price watchers, a bunch of price watchers, they're going to come in there and say, the housing market's going to crash, it's going to do this. Where's the supply? Where is the supply? The deleveraging event comes from a hypersupply phase in real estate. And we don't have a hypersupply phase, at least not yet. It's going to take some time. That's what I mean. So we've got the 2-year yield. If we look at the 2-year yield, I've got these little drawings up here. Is this kind of a shoulder, head, shoulder that can develop? It's going to take some time to develop. But you can see that we've got kind of a hump there, maybe a head potentially. I know we're early on this. And then maybe we create another shoulder where we come up in yields all the way up to create another shoulder and then head lower where we get our cleansing event in the system. So again, I don't know the future. What I am doing is I'm scribing out a potential path that could happen in the markets. To me, this looks like we're going to go up somewhere and roll over and head lower. That's going to be favorable for gold, silver, and precious metals. And I think it's going to be unfavorable for a lot of the other commodities. So one way that I look at this is like, well, maybe I could balance the portfolio differently coming up to take into account outperformance of gold, silver, and potentially the mining stocks. So that's one thing I look at. And then you can also go and look at gold itself. Obviously, people see this a lot. Gold looks fantastic from a technical analysis standpoint. It's a cup, a handle, and a breakout of the handle to the upside. That is more evidence that the gold market and the way that people are positioning in the market could be expecting a differing market condition that is coming up. And remember, being there early can oftentimes feel like you're wrong because it doesn't go anywhere. It can go sideways for a little bit if you're really early. But the way that this looks like to me is that gold is setting up for a potential move higher. And again, I'm not telling you the timing. I don't know the timing. No one knows that timing. Can't tell you if it's going to happen this week, next week, or 3, 4, 5, 6, 7, 8 months from now. We very well could go sideways for a little bit before heading higher. But I do think that this is one good area to look at for potential investments. Another thing that I look at when I look at all these different charts is how is the ETF performing against other ETFs. It's more data. So when we look at, say, GDX versus other assets, so this is GDX versus gold future pricing, we have our movement of down, sideways, and then generally you'll get a break and a move higher. That to me looks like it's basing out. We are also incredibly cheap for GDX in relationship to gold itself. So when we look at this, we can say, okay, the ETF is cheap in relationship to the commodity. The commodity is broken out to the upside, and the TYX, TNX, and all of the yields are favorable for the market conditions for gold to do well in. So if we see a favorable condition for gold, we should be looking at the gold and silver mining companies and how they're reacting to gold and some of these other market conditions. To me, it looks like we're strengthening up here some, but we are still below a lot of the breakout levels. So we haven't broken out yet, but it's looking better. And we should be watching these sectors because we could very easily see the market conditions ripen for these sectors to do very well in. And if they do very well, we want to participate, obviously, in the sector that does very well and outperforms. We can also look and see the outperformance of GDX versus REMX. So when we do this, what I can do here is I can pull up another ratio here. I pull up this ratio, I throw it in here, and what do you see? Well, it looks like the market conditions of TYX TNX ratio is the same as GDX to REMX. We're overlaying data here to show you that these are basically the same overlaid conditions. So what we're doing is we're taking the expertise of smart investors in yields and overlaying it with other data that might give you more leverage to the price move. We can also use technical analysis on ratios to some extent to see, how is this behaving. Basically, in my opinion, this is a double bottom that's broken to the upside. And we could see a outperformance of GDX versus REMX. So we're using all of this data to overlay a case that GDX and the gold and silver mining companies could do incredible things. GDX versus SILJ. Now, SILJ is another precious metal. This is signaling that SILJ is cheap to GDX and that we could see a downward move in a shoulder head shoulder. It's not a perfect neckline, but we could see a move lower where SILJ could outperform. SILJ is very cheap. Looking at GDX versus URNM. Now, URNM is very sensitive, same with XOP, to inflationary environments. It's an energy, and most energy is more it's more sensitive to a inverting yield curve versus an uninverting yield curve. We have an uninverted yield curve, and we're starting to see GDX outperform a lot of different sectors. It doesn't mean that this is just going to go straight higher, guys. It means that we're going to grind on up, and we could see a big outperformance, and we can see that move on higher with GDX outperforming URNM. This is an inverted head and shoulders, shoulder, head, shoulder, and we've got a break to the upside. We should be looking at these things. So that's GDX versus URNM, GDX versus XOP. That's also got a falling wedge and a breakout to the upside. We could see GDX start to outperform XOP and all of these other ETFs that we are following. Big picture view, you can see a trend line here. We've got a breakout and then a retest back to that breakout and then a move higher. So yeah, I do have yellow fever. I do have silver fever, however you want to call all that, because the charts are all supporting a potential move to the upside, and it's looking really good. Here's GDX versus COPX. Now, copper's pretty strong. We're coming into some serious inventory issues in copper with very tight markets. But generally, in these conditions, GDX will outperform COPX. I can throw that TYX, TNX ratio back up there. You can see how well this tracks that ratio. So tracks it very well. But I will say that copper is very tight in its market right now. And then GDX versus OIH, this is the energy service companies. You can see a clear resistance trend line here. It's a horizontal one, so when you break it, it definitely goes higher. And we've come back down, and now we've broken that to the upside where GDX could outperform OIH. And I am still a bull on OIH. I'm still a bull on all the commodities. What we have here, and what I'm trying to describe here is we have a long-term secular bull market in commodities that's going to last decade plus. We're starting to see market conditions on a cyclical, shorter-term basis start to roll over, much like 2000 to 2002. Are we going to get a rollover in yields, or do we still have to put in that last shoulder where then we roll over? I don't know. And I know that a lot of the commodities have a lot of shortages, and the markets are tightening up really tight in copper, nickel, aluminum, and even oil at the moment. Natural gas is in a glut right now because of weather in Europe, but I do think that will work its way off and provide a really good entry point at some point here. But that's what I'm seeing in the markets, and you can see clear as day that TYX, TNX ratio looks like it's bottoming, broken a downtrend line, we come up to the upside. That is the market conditions that are ripe for gold. We're seeing gold break to the upside. We've got a cup and handle pattern that's broken to the upside. It's a massive pattern, guys. Massive pattern that we've broken. And you can see that GDX is starting to outperform all the other ETFs. It's all data there for a potential outperformance of gold and silver mining. That does not mean that we go straight higher. We can go sideways. We can grind. We can go into a retest in some of our metals and miners. Doesn't mean we go straight up. And that's where cost averaging and having strategies around that can be beneficial for moves. And again, I'm buying off the chart patterns. I'm buying off things where buyers equal sellers. That's what you get, a falling wedge. You can have other patterns that are created. It's basically buyers interacting with sellers. And it's really the exhaustion of one side not being able to push the price either higher or lower. It's exhaust. If we're going up, buyers are getting exhausted, sellers are taking over. If we're going down, conversely, sellers are getting exhausted, buyers are taking over. And we're just using patterns to see that shift in preference of buying and selling. I do have a lot of individual companies that look insanely good against the commodities. That could be very good potentials. So if I were to just show you guys one last thing, I bought a lot of stock. I'll just show you the setup. So here's crude oil divided by natural gas. Actually, let's do gold to crude oil ratio. When I made a lot of money in SM Energy, what I did is I had identified this value point in September, October of 2020. It was September. That's that circle there. All right. It was at a ratio of 53. So 1 ounce of gold, 53 barrels of oil. And that is incredibly cheap for oil. It's an anomaly up here. There's just nothing that's that cheap in history. I also looked at crude oil divided by natural gas at that time. Now, crude oil is off the chart cheap. Natural gas was, I would say, in that time frame of 2020, it was around a 1 to 20 ratio, which is still very cheap for natural gas. Then what I did is I took this was my favorite company, and I priced it against natural gas. And in that time frame of September, October of 2020, it was bottoming against natural gas in a declining wedge pattern. And we've broken out to the upside and moving higher, where SM Energy, which is the company that I shared on the website here to everyone in the beginning of the YouTube channel at $1.50, it broke. So that is how I did it. Is I basically drilled down to the bottom here and found an incredibly good entry point with full alignment of gold cheap to everything, crude oil cheap to gold, massively cheap, an anomaly cheap, natural gas cheap to oil, and then a company that is incredibly cheap to natural gas itself. And that all unwinded to the other side, where it all became better valued against each other. It's not fully unwound yet, though. It's unwinding, and it's in that process. The market conditions on a long-term time frame are still there for this to unwind, where some of these companies that were incredibly cheap at the bottom are going to become incredibly expensive at the end of the bull market. It's going to take a long time, though. It's going to take probably a decade. So when people think of this, we're going to get these cyclical movements in a big secular uptrend going upward. Just like we saw in yields for TNX or any of these, they were in a up and down movement, cyclical movements in a downtrend of a secular bear market for interest rates. So there's big pivot points that I want everybody to understand. The yields going from a downward movement to an upward movement is a huge deal. This is a paradigm shift in terms of inflation. Huge shift. That's going to reprice assets differently. And it's going to reprice, in my opinion, commodities and precious metals upward and financial assets downward. And we're going to see a big rotation of money. Now, this isn't going to happen in months. I mean, it will happen in months, but it's going to happen over time. It's going to take some time. And there's going to be slower periods and faster periods during this movement where things really move and you get these gigantic impulse moves to the upside. People know it as Elliott wave. So we're going to get in waves. Those waves, you have to be invested for those waves. And there's going to be times where things outperform, certain assets or sectors outperform other assets and sectors. Today, I just showed you why I think gold could outperform over the next year or 18 months or 2 years or whatever it is. Maybe be longer than that. But that's what I used to do it. There are setups, just like SM Energy here and natural gas, where they're down here at the corner. There are setups like that in gold and silver mining companies, just like this right now. And that's where, when you look at some of these like larger time frame scales here. So this is XAU to gold. This is a gold and silver mining companies in relationship to gold. Remember what I talk about the corners here. We're in this corner. We have increasing lows coming up into this trend line. I call the trend line, need to break this line for happiness. When we break this, guys, all of this stuff is going to unwind. It's going to take time. I'm not saying it's going to be, like this 1 year and it's all done. No. These are like big moves. 10, 20, 30, 40 baggers potential, depending on the stocks that you're in. But there are setups that have occurred in the markets with some of these gold and silver mining companies where they are cheap in relationship to, I'll just say this. You've got financial assets, stocks, and whatnot. Gold is cheap to financial assets. Then the next one that's cheap is silver. So silver's cheap to gold. And then you've got silver mining companies that are cheap to silver itself. So it's a multiple leveraged play when all of these ratios switch to the other side, that you could get the most return potential out of these smaller companies. Now, I'm not saying that I'm going to go and just swing for the fence with all my money. You have to figure out allocation strategies where if you're going to take on a lot of risk, that you don't get crushed by making that your largest and only position. So I also look at how do you allocate the portfolio? What's a good allocation? And you're going to have to ride through some incredible volatility if you're going to swing for the fence with some of these higher risk companies. It's going to be moving all around on you. Timing the exact bottom, pretty much impossible. So when you buy a company, more than likely you will be down in it at some point. 20, 30, 40, 50% even. Even if you're buying at very low levels, they are incredibly volatile. That volatility is going to work in your favor to the upside. So when it goes and breaks to the upside, that volatility is going to give you the kick in the pants movements to the upside. But you have to be able to survive with whatever allocation you throw in there, that volatility in the short term. So when that money flow comes swinging back around, you can ride it to the upside. So that's what I've got for today, guys. Hopefully there's a lot in there. I'll continue to post. If you want to know the companies that have those great charts, I have them posted on the website. You can become a member if you'd like. It's finding-value.com, and you can see all those individual companies that I am investing in that have the same setup as SM Energy did in September, October of 2020. The one where I went up a lot of money, turned very little money into a lot of money, and that was not just that one company. We also saw it across a bunch of different companies. That we had that alignment that I was looking for in the markets. That alignment, TYX TNX ratio was rolling over and back down. That's one of the alignments. I didn't know about that alignment at that time, but I did link it up later. That's rolling over, which gave the alignment of it's go time for oil. We had the alignment of a 50-to-1 ratio of gold to oil, which is 50 barrels to 1 ounce gold. We had the alignment of the natural gas being cheap to crude oil, and then the alignment of the producers being cheap to natural gas or crude oil. That's full alignment. That's as good and as cheap as you're going to get in the markets. That same alignment's happening, gold and silver mining companies at this time. So that's about as high of a statistical probability as you can get. Hopefully you guys obviously like this video. I'm sharing quite a bit of information here, hopefully setting you guys up for success in your life. And if you want any further information, definitely sign up to the website, sign up to the channel. I'll continue to post things when I see this for market condition changes. And that's what I've got for today. We'll catch you next time. This is Finding Value.